Welcome to the deep dive.
Great to be back.
Yeah, so today we're jumping into PennyMac Financial Services. That's PFSI. They just reported their Q3 2025 earnings.
Right, and it was, well, a pretty standout quarter, especially compared to some others in the mortgage space we've seen.
Definitely feels like management's using this one to really hammer home their whole balanced business model idea.
They absolutely are. And, the results kind of speak for themselves this time. Disciplined hedging, smart capital moves, it all seemed to click.
Okay, so that's our mission today, right? For you listening, we want to get past just the big headline beats.
Yeah, dig into what actually drove that success in Q3. And maybe tackle the question of whether the market is, fully buying into their longer-term story.
That market reaction was interesting.
Mild, to say the least. Huge beats across the board, strong ROE, and the stock barely nudged up after hours, like 0.6%.
So either the street saw this coming, or maybe there's some skepticism about, can they keep doing this, especially with their growth plans?
Exactly. Let's lay out those headline numbers first, though. They were strong.
Yeah, okay. So GAAP diluted EPS, $3.37. Consensus was looking for $2.98, so a solid beat there.
And revenue, same story. Came in at $632.9 million. The street was expecting, nearly $60 million less than that?
But the profitability jump, that's the real eye-opener for me. Pretax income hit $236.4 million.
Which is way up from $76.4 million just last quarter. In Q2. I mean, that's a tripling, basically.
Incredible jump, and that flows right into the return metrics. They flagged an annualized operating return on equity, ROE, of 18%.
Yeah, and that 18% operating ROE, it's a key number. It strips out some accounting noise, gives you a clearer view of the business's actual earning power.
And in this rate environment, hitting high teens on ROE, that gets your attention.
Sure. And it wasn't just one thing driving it. It really did seem balanced, like they keep saying.
Okay, let's break that down. Production side, originating loans, that looked pretty healthy.
Yeah, production pre-tax income was strong, about $123 million. But the foundation, as usual for PFSI, was servicing.
Right. That's the steady part.
Exactly. If you strip out the big swings from MSR value changes, which, just follow interest rates, servicing pre-tax income was huge, $161.7 million.
Okay, so that stability from servicing is key. And that brings us neatly to the risk management piece, doesn't it? The MSRs.
Ah, yes, the hedging story. This is where that balanced model really got stress tested this quarter.
Because rates were volatile, right? And that hits the value of their mortgage servicing rights, the MSRs. They actually booked a loss there.
He did. MSR fair value losses were about $102.5 million. That's a big number.
Enough to really hurt if you're not prepared.
Absolutely. But here's the thing. Their hedging program generated gains of $98.3 million. Almost perfectly offsetting that loss.
Wow. So the net hit was tiny.
Tiny. A net valuation loss of just $4.2 million. In EPS terms, that's like -6 cents. Basically noise.
That kind of precision, neutralizing the MSR volatility, that's how you get to an 18% ROE when rates are bouncing around.
And it wasn't an accident. They talked about specific tweaks to the hedge strategy. Right. Well, they mentioned relying less on some more expensive option positions.
Yeah.
And they've gotten better at baking their own recapture predictions into how they manage the hedges.
So smarter and cheaper hedging.
That seems to be the goal. They expect lower hedge costs going forward, but they're still aiming to keep that hedge ratio high, like 85 to 90% covered, safer and more efficient.
That discipline feeds right into their capital position then.
Totally. Book value per share ticked up again, now over $81. They kept the dividend going at 0.30 cents.
And crucially, liquidity.
Looks really strong. Around $5 billion in total liquidity. That gives them a lot of firepower, a lot of flexibility.
Which they actually used this quarter with that big MSR deal.
Yeah, that was a really interesting strategic move. They sold a $12 billion chunk of MSRs.
These were older, lower coupon loans, right? Average rate around 3.1%.
Exactly. Lower yielding assets. They sold them to Amly Capital Management. But here's the clever part.
They kept the servicing.
They kept the subservicing and the recapture rights. So they cashed out of a lower return asset, but held on to the fee streams and, crucially, the chance to refinance those borrowers down the road.
That's that capital light growth idea in action. Monetize the asset, keep the relationship and the future upside.
Right. And the plan is to plow that capital back into originating or buying new MSRs with higher coupons, better returns, and more near-term refi potential, swapping out old for new.
Smart. Okay, let's shift to the origination side, the production channels. How did they perform?
Still showing strength across the board, really leveraging that multi-channel platform, correspondent lending, for instance.
where they buy loans from smaller lenders. Big volume game there.
Huge volume. They're still the leader, estimating they had about a 20% market share for the first 9 months of the year.
And margins. Volumes were maybe a bit soft industry-wide.
Margins actually improved, up to 30 basis points from 25 last quarter, shows discipline, using their scale to hold pricing power even if overall volume dipped slightly.
Okay, correspondent is solid. What about broker direct? That seems to be the big growth focus.
Oh yeah, that's where the aggressive targets are. Originations through brokers were up 6% from Q2, locks up 11%.
And market share?
Just under 6% currently. But management was really clear. They're gunning for over 10% market share by the end of 2026.
Doubling market share, basically. That's ambitious.
Very. And that's a key part of the story the market might be watching closely. Can they actually hit that?
They seem to be betting heavily on technology to help get them there, and also in their third channel, consumer direct.
Right, the direct-to-consumer channel. That's where they capture refinances from their own servicing portfolio. And that channel surged late in the quarter when rates dipped.
How much?
Lock volumes were up 57% quarter over quarter. Huge jump. And the potential here is just massive.
This is that big number they threw out, isn't it?
Yeah, get this. $291 billion in unpaid principal balance in their servicing portfolio.
Which is like 41% of the whole thing.
Has a mortgage rate above 5%.
Wow, so that's just a giant pool of potential refinances sitting right there on their books.
Exactly. If rates just stabilize around here or drift even a little lower, that's a huge proprietary source of business they can tap into using their tech. No need to fight for it in the open market.
And they're sharpening the tools for that harvest. Mentioned a new loan origination system.
Yeah, already seeing efficiency gains. They said early results show it cuts the time to get a locked application fully processed by 50%, half the time.
Faster, easier for the borrower, makes them more likely to stick with PFSI for the refi.
That's the idea. All the tech upgrades, the Vesta partnership they mentioned, it's all about making that process smoother, quicker, locking in that recapture business.
Okay, so pulling this all together, what's the big picture outlook they're painting for investors?
They're guiding pretty confidently. They expect to keep delivering annualized operating ROE in the high teens, maybe even low 20s, all the way through 2026.
That's a strong multi-year forecast. What are the catches?
Well, it assumes mortgage rates hang out around, say, 6 to 6.5%, and that delinquencies don't suddenly spike. Basically, a relatively stable environment.
But it suggests they believe this balanced model, the hedging, the servicing income, it gives them that through-cycle stability.
That's definitely the message. And they sounded pretty positive about the near term, too. Said early October activity was strong, especially consumer direct, catching that recent rate dip.
So Q4 could be good, despite usual seasonality.
They hinted that current rates might push the ROE towards the higher end of that high teens to low 20s range for Q4, even with seasonal headwinds.
What about the competition? Lots of talk about consolidation in the mortgage industry.
They seem pretty relaxed about it. View consolidation as a potential long-term positive for scaled players like them. Their multi-channel approach gives them flexibility to adapt, maybe pick up share, while others are busy integrating deals.
And efficiency is still a focus. AI and whatnot.
Oh yeah, they specifically mentioned deploying AI across the business to get more operating leverage. They expect unit servicing costs to keep coming down, and that's already baked into that multi-year ROE guidance.
Okay, so summing up the quarter, strong execution, hedging worked brilliantly, smart capital moves.
Yep, but again, that muted stock reaction, there's a disconnect somewhere.
Which leads us perfectly into our final segment.
Let's do it.
All right, this is not financial advice, just want to be super clear. We're exploring ideas based only on the earnings call data we've just discussed. Do your own research, make your own decisions. This is purely hypothetical.
Got it. So the core puzzle is that disconnect, right? Massive beat, strong guidance through 26, but the market basically shrugged.
So maybe the market is worried about execution risk. Like, can they really hit that 10% broker direct target? Can they maintain discipline?
That seems plausible. It's aggressive growth they're aiming for.
Okay, so here's a potential trade idea playing on that. What if you bet on their execution, on that proven discipline and tech advantage?
How would that look?
Maybe a long position in PFSI itself. But to hedge the overall mortgage market risk, you pair it with a short position in a competitor. Someone you think is maybe more exposed, less hedged, more vulnerable if origination volumes get choppy. A mortgage banking pairs trade, essentially.
Interesting. So you're betting on PFSI's relative outperformance. What's the catalyst?
Two things, really. First, they actually do hit or get close to that 10% plus broker direct share by 2026. That's significant growth.
Okay.
And second, they successfully use their tech platform to start harvesting that huge $291 billion chunk of their own servicing portfolio as rates ease. That capital light, high margin recapture business really kicks in.
So the combo of broker growth plus tech-enabled refi capture drives their ROE consistently up into the low 20s, proving the model works even better than the market expects right now.
Exactly. That forces a re-rating relative to peers who maybe don't have that built-in refi engine or the same hedging sophistication. That's the thesis. Plausible based on the call.
Plausible, definitely aggressive, but rooted in what management laid out.
Okay, let's wrap this deep dive up then. To recap PFSI's Q3. A quarter really defined by sharp execution, nailing the risk management, and making smart moves with their capital to set up future growth.
Yeah, they're clearly positioning themselves as this scaled, tech-forward platform designed to be profitable through different market cycles, smoothing out earnings with servicing fees and tight risk controls.
So we'll leave you with this question to think about. Given how well their hedging neutralized the MSR volatility this quarter, and knowing they have that massive $291 billion refinance opportunity just waiting,
Is the market currently undervaluing the resilience and the embedded potential of PFSI's balanced model, especially looking out over the next couple of years?
something to chew on. As always, this was just our take for informational purposes. Thanks for tuning in to the deep dive.